Hello everybody in CPSG, welcome back to day 2 of your bootcamp series. This is Patrick Kenny. I'm excited about day 2 because now today we can actually start getting to talk about trading. One of the unique things in the way I designed this course and the way I designed this bootcamp was to get you from A to Z. That's kind of the theme of this, is laser focused Forex training that will get you from A to Z. So of course in day 1 we had to teach you how to get a broker, and in order to make money you're going to have a broker. So just keep in mind that day 1, 2, and 3, we're going to try to cover these basics, and even actually 4, 5, and 6. Really the first week of boot camp is basic information, but some of it is more advanced as well. So this will move pretty quickly. I want you to keep in mind that with that broker, your deposit may still be pending. As you get your deposit in, you can use debit, credit, wire, Skrill, etc. Just double check that it did go through, because we will be starting to trade in this boot camp within the next couple of days. And so I want to make sure that you're all set up there. So once again, if you have any questions, everybody really in the company knows who I am and how to reach me. Specifically on Facebook is the easiest. So reach out to me if you do have any questions, and I'd love to help you as far as getting your broker set up. So day 2. If I could say anything about day 2 and what we're about to cover today, it's a longer video. This is going to take some time to get through. But this is by far the foundation of trading. If there was any day that you need to be here, if we're in a college course and there was any day similar to, say, finals week, this is it. This is the most important day of class per se. And the reason that is that I pride myself on this section, but also this is a section that tends to be overlooked by most people, and they forget, with all the beauty of trading strategy, that risk management and portfolio management is the most important part of it. And without this, you will never succeed. I can guarantee that. If you follow today's tasks, you're going to be profitable. I guarantee that. So I'm excited to see which way it goes. And of course, I already applaud you for just showing up to day 2. That's of course one of the most important things, is just showing up. So let's get right into it, and let's start learning a little bit. So first things first, what is portfolio management? Portfolio management might be a new word to some of you. And what it is basically a mixture of 4 things. First is risk management, and we'll discuss what that is in a minute. Balance management, of course, we'll discuss all of these. Risk reward, and currency-based mixture. If you can have all 4 of these on point, and if you can actually learn how to control all 4 of these, your portfolio, which is your account, which is your brokerage account, that's what we refer to as your portfolio, it will be profitable if you can have these 4 pillars. If one of them lapses, your entire portfolio will likely lapse. So once again, this is more important, and what we're about to talk about is more important than any strategy that you will learn. So what I want to first get into is ask questions of people that have already been trading. If you're a beginner and you've never traded before, you of course cannot answer this question. But for some traders, this is going to hit home. How many times have you found yourself doing well trading? Potentially profiting week to week, or maybe month to month for that matter, when all of a sudden a few trades wipe your account. So what does that mean? How often have you won 8 trades in a row, you lose 2, and your account's back to where you started, or maybe it's a little bit below, or heck, it could be all the way down to 0. If that has happened to you, I'm sorry to tell you, but you need this video. You need this section. Risk management would have solved that. Risk reward would have solved that. And people that are not winning and not making money consistently, this is it. I've done consulting for years now, and I've had thousands of clients come through my eyes. And the first thing I ask people, specifically when a client's traded before, is let me see your plan to control your risk. And 9 times out of 10, they don't have one. They just shoot from the hip, enter a random position size, and just invest kind of randomly. And that's a big issue. And so I want you guys to kind of really pay attention to what we're about to talk about today. So understand that what I just spoke about happens to many traders. I would argue that it happens to every trader at least once. There's always that urge for traders to begin with just very little money and try to flip it to a large amount of money. And in doing so, if they trade the wrong direction, they end up losing. And so I think almost all traders at least go through this once. And you have to really get stung, meaning it has to hurt. You have to miss that money that you lost to really start to try to look in yourself in the mirror and say, what am I doing wrong, and where can I improve? So what I'm here to tell you today is that there's no magic strategy, and no strategy is going to make you profitable. What's going to make you profitable is a combination of strategy and what we're talking about today. And there's no one-size-fits-all trade in Forex. And there's no one-size-fits-all strategy. Keep in mind, everybody has a different schedule. You know, some of you guys have full-time, some part-time, some are in school, some no jobs at all. Some of you guys can start with a couple $100, and some of you guys may have $20, $30, $100,000 accounts. Everybody's going to have a little bit of a different journey through this. And everyone I just mentioned is going to be at least something is going to relate to you. And it's okay if you start with $100 or $100,000. It's the same journey. It's the same markets, and the markets aren't going anywhere. And so what I'm about to tell you is the most important line on bottom. If you can buckle down today on these concepts, you can focus on what I'm saying. I'm here to tell you that you will become profitable. This is the most important section. So let's get in the nitty-gritty. Risk management, as defined in a definition sense, is the process of identification, analysis, and acceptance, or mitigation of uncertainty in investment decisions. How to refer that to people when they're asking, what does that mean? Obviously, you're just trying to not lose money or as much money when you lose a trade, and you're trying to handle your risk. But my kind of example for it is, if you have a test coming up in school, whether you're in school now, or if you can remember back to when you were in school for some of you guys, when you had a test coming up, majority of the time, what did you do? Or what did you at least attempt to do, or spend a little time doing? You probably studied. You looked at a study guide, you read the book, whatever. When you were studying, what were you trying to do? You're studying to pass the test. What that is that you're trying to mitigate risk or uncertainty of this quote-unquote investment, aka test. That's what risk management is. You're really trying to make sure that you're mitigating risk. And so to start this off, to get this going, what I have designed for you is basically an example of two traders. Trader number one on the left side is in the green. And this is where it cuts off. This is trader one. This is trader two. Trader one is exactly who I want you to be. I want you to be trader one. I want you to reach out to me in the next year and say, because of day 2 of your boot camp, I was successful. Because I'm trader number one. What it means is that you're risking 2% per trade on your account. And so as you can see on both sides here, what I've started with is 10 trades, and both accounts start at $20,000. Trader number one risks 2% per trade. Trader number two risks 10% per trade. Now keep in mind, the risk percent is always based off of their current account balance. So when they start with 20 grand and they risk 2%, they're risking $400. When they lose that trade, they're left with $19,600. 2% of $19,600 is $392. So keep in mind, that's why that is. They're all correlating. And so as you can see, this is an example on both sides. It's kind of a dark example to start with, but there's a purpose. It's an example of 10 losses. L times 10 on both sides. We lose 10 trades in a row. When we lose 10 trades in a row as trader number one at a 2% risk, and we start at $20,000, we are left with $16,675. When we lose 10 trades in a row at a 10% risk, we are left with $7,748. Now, I know this isn't rocket science and a pretty obvious question, but who would you rather be in the shoes of? Obviously, trader number one. I think everybody would rather invest $20,000 and come out with 16 than come out with 7. I'd definitely rather lose, $3,300 than lose 13 or so. Much rather. And so the purpose of this example is to show the power of over-leveraging your account. If you guys are consistently risking 10%, some of you guys may be risking 25. I've even seen 50. Heck, I've almost seen an entire account risked before. It's a bad habit to get in. Yes, it feels great when you're on the winning side, but it wipes you out when you're on the losing side. And in a couple of slides here, I have an example showing what that kind of looks like when it wipes you out and how hard it is to recover. And so obviously in this example, is it hard to lose 10 trades in a row with my training? Absolutely. Once you get through the next 18 days of this boot camp, I know that you're going to be able to find profitable trades. And losing 10 in a row is probably more difficult, or one of the most difficult things. It's probably more difficult than going 100 for 100. Losing 10 in a row is going to be tough because you're going to have to literally be trading the opposite direction, and we know through our training what direction to trade in. So keep that in mind, but I want to show you this as an example that you need to be trader number one. Always risk 2%. We'll discuss that in a minute. Now, as far as risk percent goes, the next question may be, how do I calculate that? Now, keep in mind that some of the words on this slide, I understand for some of you guys, are not yet defined in your vocabulary. You may not know what a stop loss is, or a pip is, or a pair, anything like that. I understand that, so I want to address that first. All of these terminology sections, all the terminology is defined in day 3. We will get to that, but this is more important than even terminology right now. That is why I'm stressing risk so much. So let me teach you real quick how to actually measure risk. What I have is a step-by-step guide here in 8 simple steps how to calculate that 2% risk. So obviously I have a link there, and it's, of course it's a video format that you're watching this, so unfortunately you cannot click on that. But what you can do is just take a screenshot or copy it down or type it in. That link will send you to a page that has the picture that you see right there on the right. This picture is a calculator I use in my live rooms and in my personal trading ventures every single day that I trade. Without exception, I use this because it allows me to risk that 2%. So what you want to do is first get to this page. Once you're on this page, the first step is entering account currency. What I mean by that is this line here is selecting what kind of currency your account is in. So if you're trading with US dollars in your account, of course, go for it, USD. If you're trading pounds, go for it, GBP, etc. And you'll see in that drop-down menu, if you click it, that there's different options. Now obviously this course is being distributed all through the planet, so some of you guys are going to have different options. That's okay, just make sure it's the correct one for you. Second, you need to enter your account size. For new traders, this means enter the amount that you just deposited from yesterday's broker that you opened. How much money did you put in? $100, $1,000, $10,000, 100,000, etc. You put that amount there. For those of you guys that have had a trade account open, how much money do you currently have in your account? Type it in here. Very important. Now the next one is probably the most important item on this sheet, and it's entering risk percent. What did we just talk about a minute ago on the slide before? We talked about that 2% risk. What this number means is the risk percent on your account. This needs to be between 1 and 3. Now if you're at 1, you're a very conservative trader. You're risking 1% of your account per trade. $1. You're risking $1 for every $100 in your account. For the more aggressive trader, you're risking $3 for every $100 in your account. So make sure that you have that every time. That's the most important. Now the next one is enter stop loss pip amount. This is really the only thing on the sheet here that might confuse beginners. So what this means, and we'll get into this, and this will come together in day 3 when we really start discussing terminology. But what this means is that we measure in the foreign exchange, similar to the stock market. If you guys have ever heard, you know, the Dow raised 250 points today. Well, in currency, euro dollar might have raised 50 pips today. We'll discuss what it exactly means and what pip stands for in tomorrow's video. But what I want you to do is make sure that you understand what that means. So your stop loss is how much in loss are you going to allow to happen. So in this case we put 50 pips. And every trade is going to be different for you. And we'll teach you how to set that, everything. Don't worry, I have your hand held through this entire journey. But make sure that you set it to whatever it is. For those of you guys that are more advanced, you'll understand what I'm saying. For beginners, just hang on for the ride and make sure you're taking notes. Currency pair is, of course, Euro New Zealand in this case. But this is whatever pair you're trading. Could be Euro dollar, could be gold, could be dollar Swiss, Aussie dollar, etc. Tons of different pairs. Make sure whatever pair that you're about to enter a position on, you put there. This is not standard. You can't just leave that there. You have to match it because every pair reacts differently with spreads and swings, and everything is going to calculate differently because of the ask price. After you enter that information, what you want to do is click Calculate, and this is going to show up. This is what you're going to use. Now, we opened the broker yesterday, so I'm only going to refer to what you guys will see from the broker yesterday. The broker you opened yesterday uses lots. When you enter a trade for a $15,000 account at a 2% risk with a 50 pip stop loss on Euro New Zealand, you're able to invest 0.862 lots. This is going to be different for everybody's account based off every single number here. This lot size amount is what you're going to enter in your brokerage. When you enter a trade, it'll say size. And of course, that's coming soon as well, teaching you how to actually do that. But it'll say size. Okay? So that's, once again, of the utmost importance for you to remember. So that is how you calculate risk. Understand this section here. This is very important. You need to know how to calculate risk. So let's move forward with some more risk management. Last time I checked, you aren't 98 or even 70% profitable. Understand, trading is not that easy. We are being told to be fortune tellers. I'm sorry, we are being paid to be fortune tellers. The only time we get paid, the only time we make money is if we correctly predict the future. And so the reason that this section is so important is to allow you to not have to be required to be correct every single time in order to make money. And so this third point is important. If you start to diminish your account, meaning you lose, you have to understand how difficult it is to get that money back. On the left side, it's showing how much of your account maybe you lost throughout the course of a day, week, month, year, whatever. On the right side, it's showing amount of profit needed for equity recovery. Now, every time I discuss this with people and clients, it becomes a question because they say, well, if I lost 20% of the account, wouldn't I need to gain 20% to get it back? Logically thinking, yeah. But if you lose, if you have a $1,000 account, write this down, and you lose 20%, 1,000 times 0.2 equals 200, right? So that means if you lose 20%, you're left with an $800 account. Now, a 2% risk on a $1,000 account is much bigger than a 2% risk on an $800 account. Meaning when you enter your position size, this one will be smaller, this one will be larger. If this $800 account is smaller, your position size is smaller, it's going to take more to recover back when you're always risking 2%. So this is an important note to have, that you don't want to lose even 20%. You get down to losing 50%, you have to recover 100% of your account. It's amazing how quick this number compounds. And so keep this in the back of your head and write this down. You do not want to get behind. And that's why, even though we're not going to be even 70% accurate on our trades, we can still make money because of this portfolio management piece. So let's get into it. Managing a proper portfolio is more than just a lot size that I just discussed. Lot sizing is important. Your position size is important. but you need to have a few standards each time. Number one is your risk percent. Number two is your risk reward. And number three is portfolio mix. Now first, risk percent, I think we can probably check that off the list, right? We're risking 1 to 3% per trade. Number two we haven't talked about as much, risk reward. And of course we haven't really allowed ourselves to get into this on the charts, but understanding the concept of it is important. What a risk reward is basically saying how much am I willing to risk for a potential reward. And it says right here 1 to 2 min. That means 1 to 2 minimum. In terms of trading, risk is the first number in front of the colon. Reward is the second. So if it's 1 to 2, what does that mean? That means that my reward needs to be minimum double my risk. So if I'm risking 100 pips, my reward better be minimum 200. This is so important. Very simple. Whatever it is, your risk must be half of your reward, minimum. We have times in the live room when I'll be a 1 to 4. Heck, I've been a 1 to 8. That's okay. You need to make sure you're minimum 1 to 2. Now, an easy way to calculate this, and we'll get into this in more of the advanced days, but I want to have you guys write this down. See if I can discard the ink. If you know what your stop loss is, which is your risk, risk equals stop loss, that's SL, and reward equals your take profit. So if you know what your stop loss is, say it's, I don't know, 100 for sake of easy math, and you know what your take profit is, say it's 200. An easy way to do it if you don't understand the concept, the easiest way to do it is if you have these numbers of your take profit and your stop loss, is go to a calculator. And you guys can do this right now on your phone or whatever, on your desktop on a calculator. But put in first, type in your reward amount. So I'll type that in the calculator, 200, and then hit the divide button and divide it by your stop loss amount. Now of course you can see from this, that's pretty easy, it's going to say 2. Whenever you hit enter, make sure that it at least spits out a number that is 2 or greater. It can be 2.14567. Doesn't matter. It needs to be at least 2 or greater. It could be 3, 4, 8, 12, 16. Needs to be 2 or greater. Okay, that is how you know you have a minimum risk reward of 2. Now third, these two are now pretty easy to cover. I think everybody would agree. Third is something a lot of people don't even know what that means. Portfolio mix. Traders tend to forget to mix their portfolio. So let's get into this a little bit more and a little deeper in detail. If you're to short, and once again short is a term that we'll discuss in the future, but if you're to sell euro dollar, is it wise to trade Aussie dollar, New Zealand dollar, other dollar pairs the same direction with the same type of trade? For example, if I go to the 15-minute time frame and I see that I see a great opportunity to sell euro dollar, then I move over to Aussie dollar and it has the same identical looking setup, and then I go over to New Zealand dollar and it's very, very similar, the same. Is it wise for me to sell or short all three of those at the same time in the same direction? What do you think? Take your guess inside of your head. But the answer is no. What you're doing is you're doubling down your risk. Because if one of these trades lose, and I put loose, I apologize about the typo, the likelihood of multiple losing is much higher. Now obviously it's vice versa as well. If one of them win, the likelihood of all of them winning is much higher. So what you want to do is find your mix. Trade one yen group, meaning one yen pair, $1, one cross, and one commodity. What you guys will notice in my live room is every day I walk in the room, with the same pairs on the bottom. And they're always grouped yen first, dollar second, crosses, commodities. You can check me on this. Every day in the live room, that's how it looks. There are no ifs, ands, or buts about this. And if you trade this way per trade, this is how you need to do it. Meaning, you can trade a yen and another yen pair, but one must be an investment type trade and the other may be a swing or a scalp, which are the different type of trades on the bottom. And as you can see, it's how long of a period. An investment type trade lasts for months or years. A swing trade lasts for weeks. A scalp lasts for days. And a spot lasts for a couple hours. So you can trade, say you trade dollar yen JPY here on an investment type trade. You trade this long, but you have a scalp right now on the same pair, UJ short. You can do that. But make sure that you don't trade UJ short in a scalp situation and Euro Yen EJ short. You do not want to do that. You're doubling down and you're just exposing yourself to more risk. All right, so a quick little cheat sheet here. This is what it looks like. And so this is showing correlating pairs. So take a screenshot, whatever you got to do. But what it's going to help you with is to not mix and match. It's just showing that if euro dollar and dollar yen are going up, then euro yen is probably going up, up, up. And it's obviously all just based off of the strength of the currency, the strength of each pair. And so this is important because you do not want to contradict yourself on these either. It's not as simple as just the groups. But if you see this happening, if you see euro dollar going up, you see dollar yen going up, is it wise to short euro yen? Go down, lower? It's supposed to be a downward arrow. Probably not. Probably not wise. And so that's another important thing to note. Keep this slide handy. All right? Now, if you can grasp these concepts, you're going to take pressure off of winning every single trade. And a lot of people, that's the main issue that they have, is that they think they need to win every single time to make money in the foreign exchange. That is just not true. What you need to do is understand that the market is always right. There is no way for you to always be right. The market's always right, but you're not. I'm not, nor is any professional trader out there, any portfolio manager, anybody. If you can trade on the correct side of the market with the trend in conjunction with these principles, you will be profitable in, of course, well, 17's over now, the time I'm recording this. I started designing this in 17. Or 18, or heck, this course is going to be out there for years. So if you're watching this in 1920, everything remains the same. You just need to understand these principles for your portfolio. So once again, these concepts need to be remembered. And those three are so important: your risk percent, your risk reward, and your portfolio mix. If you can keep those three together, you're going to take a lot of pressure off of yourself. All right. Once again, I'm very reachable. You guys know where to find me. Reach out to me if you have any questions getting your broker set up. We're only on day 2. We have not even gone on a chart yet. I'm excited about day 3, but because we're going to learn all about Forex. It's time to actually get in there into the nitty-gritty and start to learn a little bit about this beast, the market that absolutely changed my life and many, many, many other lives. So I'll see you guys back here tomorrow for day 3 of your boot camp.